Crypto uses many new terms and concepts that beginners find difficult to understand. Important information, news, and analysis of crypto are hard to access because they require prior knowledge of crypto concepts. Let's feed both these birds with one grain, where we explain concepts you need to know about crypto and put them into the context of current developments to make sure you learn crypto with news. What was the Titan bank run, the first large-scale bank run in DeFi? What can we learn from the IronFinance disaster? In this video, we'll learn about 1. What are algorithmic stablecoins? 2. What was IronFinance? 3. What was the Titan bank run? 4. What can we learn from it? And 5. What happens next? Stablecoin projects aim to maintain a peg to the US dollar and mostly fail to do so. USDC and USDT maintain their peg but are fully centralized. Stablecoins like DAI and RAI are inefficient because they need a lot of collateral. Here's where IronFinance comes in. Launched on Binance's Smart Chain in March 2021, IronFinance quickly expanded to Polygon in May, picking up steam. The TVL or total value locked passed $2 billion. Titan, the token on Polygon, skyrocketed from $10 to $64. Yield farmers stood to gain an APR of 500% from Iron USDC and 1700% on riskier pairs like Titan Matic. Mark Cuban's timely mention of Iron further boosted it. Iron sought to fix the capital inefficiency of DAI RAI because a combination of USDC and Titan on Polygon could let it gradually decrease collateral. How does the protocol work? When the price of Iron fell below $1, you could buy it and redeem for $1 worth of a mix of USDC and Titan. When the price rose above $1, you could mine new Iron for $1 of a mix of USDC and Titan, driving supply up and price of Iron back to $1, achieving a soft peg. Hence, starting with a TCR of 100%, it could gradually reduce this. Here we start to get technical. So follow the link above for a quick tutorial on TCR and ECR. If TCR is less than ECR, the protocol has excess collateral. The opposite is true if ECR is less than TCR. On 16 June 2021, a massive bank run crashes Titan's price to zero. Large liquidity providers, or whales, sold Titan directly to USDC rather than redeeming Iron. This unpegged Iron from the US dollar and scared everyone, triggering a sell-off. While it recovered, the whales started selling again later, and this time the reaction was fatally fast, creating a negative feedback loop by reporting prices that were slower and therefore higher than the market prices. That meant I could buy Iron for $0.9, redeem for 0.75 USDC and 0.25 Titan, and sell the Titan immediately. This drove the price to zero. First, like a regular bank's risk system, a worst-case scenario should be built into the protocol, based on what would happen if the token sharply lost value. Second, protocol mechanisms should also plan for the price oracles getting compromised. That is, reporting stale prices creating arbitrage opportunities. Third, if the value of even a single asset can drop to zero, even if there are other tokens that don't lose any value, then holders can still lose all their capital. In this case, it didn't matter that Iron didn't lose value. The fact that Titan went to zero meant the impermanent loss was 100%. Will IronFinance get to the bottom of their protocol flaws and fix it? Can they relaunch what was briefly a workable model for an algorithmic stablecoin? YamFinance had a similar experience of launching a fixed version of their protocol, and the project was a failure. Markets are unforgiving. Still, there is clearly capital and risk tolerance looking for the next big thing in DeFi. And like any bank run, the survivors and new launchers learn quickly from faulty fundamentals. Subscribe to the MyMoneyKarma channel and don't miss out on regular and essential insights from the world of crypto. What is APR? What is APY? APR, or annual percentage rate, is a percentage that represents the cost of a loan or income earned on an investment. It provides you with a bottom line number to compare among lenders, credit cards, or investment products. If you have a deposit that pays 1% interest each month, your APR is simply 1 into 12, that is 12%. This does not take into account any compounding. That's where APY, or annual percentage yield, comes in. If your APR is 12% on a deposit of Rs 1 lakh and the interest compounds once a month, your interest payment for the first month is Rs 1000. Now your deposit is Rs 1 lakh 1000. The following month, your monthly interest is Rs 1010. Effectively, your interest rate for the year is 12.68%. This is your APY. Why is APR different from a nominal interest rate? APR includes various fees that add to the cost of funds. This is especially important in crypto, with holding fees, wallet fees, and transaction fees often being quite high. What is TVL? TVL or total value locked refers to the sum of all assets secured in the smart contracts of various DeFi applications. It identifies how much capital is in use across the DeFi ecosystem. It is calculated differently based on the use case. For instance, in lending, TVL is the sum of assets deposited into smart contracts by lenders and borrowers. Similarly, for decentralized exchanges, the TVL is the sum of assets into the exchange protocol. For instance, here Uniswap has a TVL of $6.26 billion. TVL is an important metric to gauge the health of the DeFi and yield market, especially when calculated as a TVL ratio. The TVL ratio is the market cap divided by TVL, where a market cap is calculated the same way you would for a stock. That is, total circulating supply multiplied by current price. A simple rule of thumb, if the TVL ratio is less than 1, the DeFi is usually undervalued. What is yield farming? Yield farming, also known as liquidity mining, lets you make more crypto with your crypto. First, you deposit crypto into a liquidity pool. This pool helps create a marketplace where users can lend, borrow, or exchange tokens, paying a fee in return. This fee is then paid out to you based on your share of the pool. Some platforms, especially new ones trying to attract users and activity, pay high yields for farming. But yield farming comes with its risks. It requires a lot of capital, mostly attracting whales, and the underlying smart contracts are vulnerable to bugs. Yield farmers use some popular platforms like Compound Finance, an algorithmic money market, MakerDAO, a decentralized credit platform, Aave, a protocol for lending and borrowing, and Uniswap, a DEX or decentralized exchange for token swaps. What are TCR and ECR? If you've taken a loan, you've likely heard of terms like the debt to collateral ratio or DCR. Let's say the value of your collateral is Rs 1,000. If the amount of debt you take out on this is 2,000, then your DCR is 2. This DCR is set by the lender or by regulators. In crypto, it is set by the protocol. TCR is the target collateral ratio. When TCR is 1, you get collateral of $1 for every $1 of crypto you mine. When it drops to 0.75, you only need 75 cents of collateral, just like with your home loan. That brings us to ECR, the effective collateral ratio. In reality, the ratio of total collateral stored as USDC to total crypto will not exactly equal the TCR, because prices are dynamic. If ECR is greater than TCR, then there is excess collateral. This usually happens when demand for the coin is high. What are liquidity pools and liquidity providers? A liquidity pool is a digital pile where funds are collected and logged in a smart contract. These funds then facilitate lending, trading, etc. Users who add these funds are called liquidity providers, and they earn fees on these funds based on the trading and lending activity that is spurred by the pool. Their fees are proportional to their share of the pool. So if you contribute 100 rupees to a total pool of 1000 rupees, and the pool attracts many traders that incur a total fee of rupees 50 by the end of the day, then you get a 10% cut, that is rupees 5 for your contribution. In any form of electronic trading, there exists an order book, that is a collection of open orders. These orders are then matched. With crypto, this becomes difficult because everything is on the chain. Liquidity pools fix this problem. If you want to buy, you don't need a seller at the same time, only enough funds in the pool. Pooling liquidity is used as a way of yield farming and also for tranching, another concept borrowed from traditional finance. What is impermanent loss? Suppose you provided liquidity to a DeFi pool of tokens worth Rs 1,000. If their current value drops to Rs 750, you suffer an impermanent loss of Rs 250. How can you lose on liquidity funds? And why is it impermanent? First, losses occur because token prices are always changing. Some tokens, like stablecoins whose price remains within a tight band, run lower risks of impermanent loss. They are called impermanent because they are only realized once you withdraw your funds from the pool. Importantly, impermanent loss happens regardless of whether the token price goes up or goes down. It depends only on the volatility of the token. So if you're depositing into a volatile liquidity pool, you are exposed to the risk of an impermanent loss that needs to be offset by whatever fees you expect to make.